My name is Joyce Brown, and I'm the administrator for the Dallas County Home Loan Counseling Center. We are a home ownership counseling agency, anything dealing with home ownership. We primarily work with first-time home buyers to help them become homeowners. We have free home buyer education class, credit repair class, and financial literacy class. Once you own your home, if you had any questions about property taxes, homeowners insurance, that escrow analysis statement that you receive from your mortgage company, we can help explain that for you. If you ever had problems making your mortgage payment, we can work with you and your lender to help you keep your home as long as you show that you have the ability to make the mortgage payment. And then also we do reverse mortgage counseling. Reverse mortgage is a home equity loan for anyone that's 62 years or older, and we provide counseling for that. You have to have counseling before you can make the loan. So we can help you with anything dealing with home ownership. So today, I'm here to talk to you, once you purchase your home, what are some of those things that you need to think about after you own your home? So everybody closes at the title company. They're really excited. You've gotten your keys. And what is the first thing you think of when you first get your keys to the house and it's yours? Most people talk about changing those locks. Everybody's going to change the locks. But it's just a little bit more that you need to think about. Once you get settled, now if you have not picked up a handout, can you raise your hand? You got some handouts on the table can bring to you. She's going to bring you some handouts. Keep your hands up. We're going to talk about what I call strategies or things that you need to know to make sure that your homeownership dream does not turn into a nightmare. Because things can happen. If you're not aware of it, you'll say, well, I was so happy about owning this home, and now, I got problems. So it's 4 areas that we're going to look at. One is what I call home ownership money management. You created that budget before you purchased your home, and now that you're in your home, you've got to look at what those additional expenses are going to be, keep the home. Then you've got to think about home maintenance. When you rent, it is so easy to pick up the phone and call the landlord and tell the landlord, would you come fix this? Would you come change the light bulb? But you can't do that once you own a home. Who are you going to call? Me. You're going to have to call yourself. I always say, okay, Joyce, the hot water heater's not working, so you need to pick up the phone and call the plumber, because you've got to call yourself. Next thing we're going to talk about is property taxes and homeowners insurance. Something that you're going to have to monitor as long as you own your home, and it's real important, that you look at that. And the last thing we're going to talk about, some of those things that you need to know just to make sure that you maintain, your investment. So once you move into your home and you've been there for 2 or 3 months, then you really need to sit down and pull out your budget sheet. Now keep in mind, you probably made a budget before you moved in the house. Now that you're in the house, you've got to look at those expenses. Because a lot of people, what they say, well, I pay $1,000 a month now for rent, so I should be able to pay a $1,000 mortgage payment with no problem. So very first thing, once you move in the house, I want you to start looking at your expenses. Everybody knows that with a budget, you're looking at your net income. You subtract from that your expenses, and hopefully you have a surplus. Because if you don't have a surplus, if you have a negative, what does that mean? You better find another job, or find a job that's going to pay you higher, a part-time job or something. So once you move in the house, were there utility expenses what you estimated? Or are those utility expenses more? You're in maybe an apartment, that's less than 1,000 square feet, and then you move in a house where the square footage is going to be 2,000 square feet. That's more home to heat. Also, transportation costs. A lot of times people don't think about that. You were only living 5 miles from your job. Now you live 10 miles from your job. How much extra are you having to pay when your gas expense? Hopefully you move closer and decrease that expense. but you've got to look at those expenses. Also, you need to make sure that the property taxes and homeowners insurance that were included in that monthly payment estimate that they gave you at closing is going to be the same. One important thing you need to keep in mind: if you purchase a new construction home where they built that home from the ground up, at closing, sometimes the lender will only base the property taxes on the value of the property before it was completely built. So basically, you're just paying land taxes. So when you estimated it with the loan officer estimated your monthly payment based on property taxes that were actually built. But at closing, when the title company gets their form from the tax appraisal district, it's going to show just land taxes. And so that may be all that you pay that first year. And you get to closing, that payment is less than what the lender told you. You thought, oh man, that lender told me I was going to have to pay $1,200 for taxes for my monthly payment. All I'm having to pay is $1,000. You think you probably, oh, well, they really messed up. You know, I'm really got a good deal. But what happens is that first year, you're only going to pay that land taxes. And so the following year, when the improvements are shown with the tax appraisal district, you're going to have to pay tax value on the property plus the land. So keep in mind, they call it the improvements plus the land. So if you're buying new construction, be very careful that if you close and that payment is lower, that difference, you need to save that because the lender is going to come ask for that. And we'll talk about that just a little bit later. Next thing you want to look at is, now that you're a homeowner and you're responsible for all those repairs, you want to estimate what your future repair expense will be. Normally, when you purchase a home, the seller is going to provide you with a seller's disclosure. If it's a pre-owned home, they'll give you a seller's disclosure. That seller's disclosure will tell you everything that they've done to that property. Once you look at that seller's disclosure, and maybe the seller says, well, I replaced the hot water heater, this year, you're like, okay, well, I know that if they replace that hot water heater this year, then I know that I've got a long time that that hot water heater will work, and so I don't have to worry about that expense. You also should have had a home inspection done. Did they talk about home inspections earlier in the first class? Just a little bit? If you don't know anything about autos or cars and you're going to buy a pre-owned car, wouldn't you want a mechanic to look at that car before you purchase it, to let you know you've got a pretty good deal? If you don't know anything, well, it's the same thing when it comes to purchasing a house. You have a home inspector that can go through that house. Usually that inspection is going to take a couple of hours, and they're going to tell you everything about your house. They'll tell you about the foundation. They look at all the major systems, the roof, your electrical system, the plumbing. They're going to look at all of that. And in that report, they will tell you things that you need to watch when you own your home. A lot of people take that inspection report, okay, I got the inspection. They told me I should get one, and they'll just put it to the side. But when you start looking at what you need to save and start putting away for repairs, that is a good report to have. So you want to go back and look at that home inspection report. Based on the home inspection report and that seller's disclosure statement, then you're kind of able to estimate just what you need to set aside for repairs. Because a lot of people think, well, okay, I got homeowners insurance. If that roof's got a leak, I'll just call the insurance company and tell them to come fix it. It doesn't work like that. Insurance companies will pay on things that happen, like you have a hailstorm. That messes up but maintenance, regular wear and tear, they don't pay for that. So you want to put estimates. So say, for example, you find out that you have a 15-year roof, you only have 10 years left, and just for sake of making it easy, you've got a 15-year life on the roof. It's been there for 10 years. So you got 5 years you're going to have to save, for that roof. So you've got $5,000 that you're going to have to save. So you're going to need to save $1,000, a year. So just take that $1,000 divided by 12, and that's what you're going to set aside each month, to make those repairs. So once you've looked at, the roof, how long was the hot water, when was the hot water heater installed? On that hot water heater, it'll have a date when it was installed. It'll tell you that. The condition of your AC unit, the heating unit, your electrical system, when the plumbing was updated, then you have a good idea of how much money you're going to have to set aside for repairs. Because you have to make the repairs now. No one else is going to make those repairs for you. And then another thing you're going to think about is emergency fund. You've got to have an emergency fund. Anybody listen to Dave Ramsey, a personal money management expert? He tells you to have at least $1,000. And I can tell you, I hate to admit this, but before I got into all of this, I kind of lived paycheck to paycheck, and I just let my husband be my emergency fund. But I said, okay, Dave Ramsey, all I have to have is $1,000. Because, most places tell you to have 2 or 3 months of your expenses. So I was like, I can never reach that. But, $1,000, I could do that. And so once I had that $1,000, it made such a difference. Because I wasn't having to rob Peter to pay Paul to be able to pay for all of those maintenance expenses. So you've got to have an emergency fund. Homeowner's insurance. Does anybody know what your deductible will be on a homeowner's insurance policy?
10%.
How much?
10%.
No, it's going to be 1%. But if you have value, insurance value on the property, and you have a $150,000 house, 1% is $1,500. You have to have that deductible before the insurance company may give you funds to make corrections on your house. So you're going to have that emergency fund. What if you have to make emergency repairs? You'll need money for that. What if you have a job loss, have illness? You've got to have some money set aside for that emergency fund. And you can start small, you can put, $50, $100, whatever, but you've got to have an emergency fund. So once you get all that information together, then you're going to sit down and you're going to start looking at your budget. It's real important now that you've moved in the house to see how these new expenses fit in the budget. Now, once you figure out what new expenses that fit in the budget, then one other thing you're going to have to make sure that you do is that you're going to have to include all these other expenses that are not included in that mortgage payment. So if you look on your handout on page number 3, as I said before, most people say if I'm paying $1,000 a month rent, I should easily be able to pay $1,000 a month mortgage payment. But let's look at what the costs are. So what's included in that mortgage payment? In your mortgage payment, you're always going to have the principal and interest on your note. You have homeowner's insurance. You have property taxes that you have to pay. The homeowner's insurance is going to be 1/12 of the annual premium. Your homeowner's insurance is going to be 1/12 of that annual premium. And so if you add that together along with mortgage insurance, and keep in mind, mortgage insurance is not for you. It's for the lender. If for some reason you default on the note, it allows you to purchase a house without having to put 20% down. So you add the principal and interest, your taxes, your homeowner's insurance, and the mortgage insurance. That gives you the payment that you have to pay to the lender. But let's look at the other costs. What are your utility expenses? You have to have that. And then you've got to have something for emergency and repairs. And once you figured out how much you're going to have for those repairs that need to be done in the house, estimated that, how much you're going to need to save a month, and you add that together, and that's going to be the total cost for you to own that house, that total monthly cost for you owning the house. So in this example, I have a $100,000 mortgage at 3.5% interest rate for 30 years. You see the principal and interest is $580, property taxes are $197. Your homeowner's insurance is $70. Mortgage insurance is $100. Total payment to the lender is $947. And a lot of times everybody can make that with no problem, but they don't estimate those utilities. In this example, the utilities are $300. They're setting aside $50 for maintenance and repairs. So the total cost to live in that house each month is $1,297. So that is one of the things you really have to look at when you're purchasing a home. Just what is that cost for you to live in that house each month? Any questions? Okay, so everybody understands that once you've been in that house for 3 months, you're going to sit down and you're going to look at how much it's going to cost you to live in that house each month. Next thing we're going to talk about is home maintenance and repairs. Like again, when you own your home, you know that you're the one responsible for the maintenance. So there's some basic regular maintenance things that you need to look at. The exterior paint on the house. The house does have to be painted. Anyone have some young teens in the house? Make those teens paint. Give them something to do in the summertime when they're out. I can remember my husband telling me about how his dad, they had an all-frame house, but every summer, they knew that they were going to have to paint the house. Painting was one of those things that, if it's not done right, you just start all over and paint over it. But you have the exterior paint. You have to be careful of chipping, peeling paint. Gutters and downspouts, those have to be cleaned on a regular basis. Make sure you keep the trees off the roof of the house. If you want to maintain the life of your roof, make sure that those tree limbs are not touching the roof. You want to make sure you replace those AC filters every month. And anyone has home warranty insurance. When you close, usually the seller will provide you with a home warranty insurance policy. So if anything in any appliances should break or anything, then you can just call and you can get a reduced rate for having the repairs done. Just know that if you do not provide the maintenance, you're not changing those filters out each month, they come look at it and say, okay, they didn't maintain, that appliance or that air conditioner or heating unit, and your warranty would be void. You couldn't use it. So just remember that. Check all your plumbing connections, that you have in the house. Weatherize your home. You would be surprised what difference it would make if you looked at weatherizing your home. If you would put the insulation in the attic or updated your refrigerator. If you monitored had what is that, thermostat. If you have the thermostat and you can have it preset. I said it does not make any sense for you to keep the house cool or warm and you're not there. Just wasting electricity. So look at weatherizing your home using things that would help you save, like the new fluorescent light bulbs that they have out that you could use. Insulate those windows if you have to. Put new, more energy efficient windows, in the house. When you own your home, you're going to have water repairs. I'm quite sure if you look on page 7 at the very top, everybody knows what that is. They've seen that before. Very inexpensive tool to have in the house, a plunger. Do you know where your cutoff valves are? In the bathroom. Anybody knows where that cutoff valve is? Even when you rent, you should know where that cutoff valve is. So if you have any problems, you can cut that water off. The supply lines to the washer and dryer. A washing machine, those have to be changed. If they're not changed, you could come in one day and find that they have burst. That dryer, the vents in the dryer, it accumulates all the lint, and that needs to also be cleaned out. Anybody heard that what happens if you don't clean that out? Fire. Burn up your whole house just because you didn't change that one thing, clean out that one thing. Know where your electrical panel is. And your electrical panel, if the previous owner did not do it, you need to make sure that you identify what those switches are for. For the bedroom, the living room, is it for the separate plug for maybe the refrigerator? Know about those on that breaker panel, what those switches are for. Know where your electric meter is. If you have gas, where the gas meter is. Also, in this Texas heat, what is the temperature today? 104? Can you imagine what is happening to the ground in Texas? We got this strange soil in Texas. I'd never seen anything like it until I moved here. But when it is dry, what do you see? What do you think those cracks are doing to your foundation? Cracking it. One simple way that you can prevent that from happening is use a soaker hose. Very expensive. You can purchase those from any of Home Depot or Lowe's. Get that soaker hose and put it around the foundation of the house. Maintain that foundation. Keep it moist. Because if it dries out, if you look at your yard and you see the cracks in the yard, then you know the same thing is happening, to your foundation. Real important. And then smoke alarms. I think in most cities now they do require the smoke code. The city code requires that there's smoke alarms that are, in the home. You need to have that, as well as a COT detector, to check the gases and things like that. Real important to have in the home. Also, you want to make sure you have a fire extinguisher. So if you have something that should happen, maybe you're cooking on the range and you forget, or maybe you do something that causes a fire, it's really good to have that fire extinguisher handy. And they're not very expensive that you can use and put that fire out. So I just touched on a few things when it comes to home maintenance and the safety, things you can do for safety in your home. Any questions there? So everybody knows that they're going to make sure that they're not the ones that destroy their house. We worry about other people, but we have to make sure that we're handling those things that we have. Real important. This is one of the things I think is very important that you should know when it comes to property taxes and homeowners insurance. So I'm just going to give you a little basics first, just on property taxes and homeowners insurance. Your property is assessed by an appraisal district. In Dallas is the Dallas Central Appraisal District. In Tarrant County is Tarrant County Appraisal District. And each year, or maybe not every year, but they will check your value of the property. Now, this is a different value than what an appraisal at a lender. So when you have your home appraised, when you first purchase your home, that appraisal will look at everything in a small area right around your house. They're looking for comparable sales that are near your home. At the appraisal district, they're looking at blocks when they make their decision on the value of the home. So by looking at these blocks, sometimes they do make mistakes when it comes to what the actual value of your property is. They assess the value so that your county, your city, the school districts, community college districts can know how to tax your property. So everybody's using the same value when they provide tax your property. When you own your home, you will be paying the city, you'll be paying the county, and included in that county tax is going to be the hospital, district. You're going to be paying for that. The community college district, you're paying for that. If you had to go, and the school district. So normally in Dallas County, I'm not sure about Tarrant County, but in Dallas County collects for almost all of the cities and the school districts. I think there's just maybe a couple places that they collect their own. So just know that once you paid off your home, you're not just paying one place, you're probably paying about 4 or 5 places that you're going to have to be responsible for paying those taxes on. Property taxes will increase or decrease. Increase or decrease based on the value of your property and what we just heard on one city. What do sometimes the cities do when it comes to taxes? I've never heard of them lowering the taxes. I mean, I can't remember anyone ever coming in and say, you know, I'm lowering it. And in fact, they always like to say, oh, we didn't raise the taxes this year. No, they didn't raise the taxes this year because the value went up. So as that value increases, they collect more taxes. So the tax bills usually go to your mortgage lender, and your mortgage lender is usually going to pay, you know, those property taxes for you.
So with our property value went down, like in 2008, the taxes?
Yeah, she questioned when the property values went down, did the taxes go down? Yes. So it fluctuates. It could go up or down. You know, and one thing, if your appraised value on the tax records say $100,000, and you know that you purchased that house for $150,000, please do not call the appraisal district and tell them they made a mistake, that your house is worth $150,000. Because then they'll go back, since you've gone in and protested it, they will go back and look, oh, we did make a mistake. Your house is worth $150,000. So now what has happened? Taxes go up and mortgage payment will go up. So if your tax value is lower than what you pay for it, let it stay low. Don't tell anybody at the Dallas Appraisal District or the Tarrant County Appraisal District, because you want to make sure you keep that low. And know that property taxes take a priority over everything. So if for any reason the mortgage lender did not pay your property taxes, and they will always make sure they pay, that lien position means nothing, because the taxing authorities can come in and foreclose on that property. That's why everybody want to make sure that those taxes are paid. Every year you'll get a tax notice, you know, from the appraisal districts telling you, usually about in October, telling you what your taxes are based on the value. And taxes will be due the following January 31st. If you see that the value that they're using, they'll send you a letter out and say, this is what we estimate the value is. If you know that value is not correct, you have in the month of May the ability to protest that value. Real important. You only have in the month of May. So by May 31st is going to be the last day that you can protest the value. So if you look at the value they've estimated, call that real estate agent that helped you purchase the home. Ask them, what is the value of my property now? If that value of your property is lower, then you need it's just a very easy process. Mail in the letter, or you can go down to appraisal district. They can help you complete that form and protest that value, because you want to keep that value as low as possible. If you think the property is not in good condition to warrant that higher value, you can go in and you can protest that. So you want to make sure you do that. And of course, as a homeowner, you want to make sure that January 1st, after the year you purchased your house, so even if you purchase it for December 31st, when January 1st comes, you can file a homestead exemption. Real important to file a homestead exemption, because it allows you to be taxed at a lower value. You only have to do it one time, just one time. It makes the difference, such a big difference in what you're going to have to pay, you know, in your property taxes. Also, it protects your home, because it says, this is my home, this is where I live, and it protects it from foreclosure by other creditors. Now, the mortgage company who has a lien on the property, it does not protect you from them, because you already have a sign in your deed of trust saying that if you don't make your payment, you know, then you are going to can lose the house in foreclosure. Question? homestead exemption. So you want to file the homestead exemption. And you'll get plenty of letters in the mail telling you, let me be your agent to handle this for you. You don't need an agent. You don't need to pay anybody anything to handle that for you. You'll have letters come in the mail after you close talking about they can help reduce your taxes. Don't pay any attention to them. They're just taking your money. You can go right down to the appraisal district and they have people there that can help you. That homestead exemption gives you about a 20% decrease in your property taxes. If you are over 65 years old or you're disabled, you can also file an exemption for that. You'll save up to 60% of your tax bill. So just a quick reminder, make sure you file your homestead exemption by April 30th, because you only have between April 1st to April 30th. It's a one-time exemption that you have to pay. Every year you will get a tax statement from the appraisal district telling you what the value of your property is, and you have an opportunity to protest that value from May 1 through May 31st. If you don't protest it, you can wait until next year to protest it, but you only have that time frame. Usually they send out the tax bills in October, and those taxes have to be paid, which most mortgage lenders pay in November, December, but they have to be paid by January 31st of the following year. Quickly on homeowners insurance. On your homeowners insurances, most policies, you can see there, they pay losses for fire and lightning, sudden accidental smoke damage, explosion, vandalism, riot and civil commotion, aircraft and vehicles, windstorm, hurricane and hail, and sudden accidental water damage. Maybe your hot water heater bursts and water gets all of it. It'll pay for that. But if it floods inside of your house, don't pay that. If your roof is just worn, does not pay that. And kind of touched on that. When you make a claim, it's real important to know that when you're making a claim, there are two types of coverage you can have. You can have a replacement type coverage, where whatever the cost of that replacement is, they will replace. So say for your roof, whatever it costs to replace that, they would replace it. Then they have the second one where they will look at the wear and tear that was on your property, and they will make a deduction for depreciation. How much did that depreciate? So just know you have two types of coverages that you need to look at. So when you make that claim, you could be looking at the cost of that minus your deductible. Most mortgage lenders are just not going to give you the check without making sure that those repairs and everything had been done, which means you would have had to pay the deductible. Yeah, her question is flood insurance separate, and it is separate insurance that you have to pay. So even if you're not in a flood zone, and this is what, with all the rains that we've had, a lot of people saw that water standing coming into their house. They were not covered, on their insurance for that. Okay, so I went through all of that about the insurance because it's really important that you monitor insurance, and just know that you can change insurance companies every year. The lender does not choose your insurance company. So you can change that insurance company every year. You don't have to use the same one. Because the mortgage lender is paying for your insurance and putting that money in an escrow account. And this escrow account is just an account you can kind of think of as a savings account that does not pay interest to you. The interest is paid to the lender. But every month when you're making 1/12 of your homeowner's insurance, it goes into that account. So every month money is going into that account for the insurance. When it comes to your property taxes, every month money is going into that account. So when your taxes become due and your homeowner's insurance become due, then they're going to pay it for you. So you don't have to worry about that. Some people think that, well, I could do it myself, but I can tell you after years of experience, especially during the foreclosure crisis, when people were having, they were paying their own property taxes and homeowners insurance, their minds had got fixed on that principal and interest payment, and they paid that with no problem whatsoever. But when there were problems, they had not factored in those taxes and homeowners insurance. And a lot of them were losing their home because of that. So I recommend to anyone, I don't care how much money, I guess let's tell you, if you're one of the folks got $600,000, $1 million in the bank, well, you probably got plenty of money. But if you're just regular folks like us, you're working paycheck, living paycheck to paycheck, depending on someone to make sure they pay you, they don't throw you out the door, then you need to make sure that your lender is paying your property taxes and homeowners insurance. So on page number 12, I just give you an example. And so your property taxes and your homeowners insurance, the annual premium is divided by 12. That's how much is included in that escrow account. And then you have mortgage insurance. If you didn't put 20% down, you have that mortgage insurance that you're going to have to pay. So that goes into that account, each month. Every year, a question.
So let's say you pay your taxes through your mortgage, and then at the end of the year, your home value or the property taxes have increased, and there's a deficit.
You hold it, because we're getting ready to get to that question just in a few minutes. So every year you're going to get a statement from the lender telling you what they estimated, because this is an estimate. They estimate what they think that your property taxes and homeowners insurance is based on what you paid the previous year. When they pay the tax bill, hopefully when they pay that tax bill, it's going to be the same as what they estimated. We hope. So when you receive that escrow analysis statement from the lender, each year, it's going to show you exactly what they paid and what they have estimated that you're going to pay for the following year. And there's 4 sections that they have. They show those payments that were made from the escrow account, everything they paid from the escrow account from the previous year, what they estimate are going to, the payments will be for the next year. And then they're going to estimate how much you have to have as a balance. And usually they want to see 2 months payments in that escrow account, because they want to make sure that if those taxes and insurance are more the following year, they don't want to have to pay anything out of their pocket. They want to pay it out of that escrow account. And then they're going to tell you what your monthly payment will be for the next year. So let's look at page number 13. This is what you want to have. They estimated that your insurance was $1,500 a month. Actual insurance was only $1,200 a month. The difference is $300 a month. So since they did not have to pay as much as they estimated, then you're going to see that your payment will probably decrease some. But what normally happens is that sometimes you don't have enough going into that escrow account. And that's why it's so important to monitor your property taxes and homeowners insurance.
Is an escrow account mandatory?
Her question is an escrow account mandatory, depending on the loan that you get. If you get an FHA loan or a conventional loan and you're not putting 20% down, it will be mandatory. The only way you can get out of an escrow account is if you put 20% down or more.
And is there interest on the escrow?
Her question, is there interest on the escrow? Of course not. Not to you. It's going to be to the lender. The lender feels that you're paying them to manage this for you, so they should get that interest on that, what's in the escrow account.
Do we get charged financial interest on the escrow because they're managing it?
Oh, no. Because they're getting the interest off of that money while it's sitting in their bank.
Got it.
Okay.
What if you pay your home off early?
Oh, good question. No, you never get any of the interest. But if you pay your home off early and there are still monies remaining in the escrow account, they will refund that to you. So, a question.
If your lender sells your account to another lender, and you don't have an escrow with the original lender, but when they sell your account, can the new company put an escrow account on there?
It depending on the type of loan. If you have a basic FHA loan or a conventional loan, you didn't put 20% down, that escrow account will transfer to, no matter how many times that account changes the servicing, the servicing lenders. It can change 4 or 5 times. They will transfer that escrow account. Now, sometimes what happens when they transfer that account, they don't wait till your anniversary year to review it. That escrow account to do escrow analysis. So when they make that transfer, sometimes you may see increase or decrease in your payment because they do a new analysis.
Well, what I'm saying is you don't have an escrow account. Let's say you have no escrow account.
Oh, talking about with the original lender, you did not have an escrow account, and then it goes to the new lender. Yes, they can. Even if you put, and I did not believe this until I just saw it recently. Got an issue with a lady right now in which we're having that problem trying to convince them that she should not have an escrow account. She's had the house for 11 years, never had an escrow account. Now they're putting one on it. So I don't think it's right. I could understand if she had been delinquent, but she had not been, delinquent. So it can happen. The servicing rights are sold. So you might have your loan with Wells Fargo, but Wells Fargo has another company that's handling the servicing, collecting the payments, making sure property taxes are paid, your homeowner's insurance. That changes, and that can change 4 or 5 times. As long as you have the loan, it can change. So I call this the double whammy. I made up this term because I can tell you, if you have your mortgage payment increased by, $200, that's like somebody just hit you across the head and you're trying to figure out what to do, especially if you don't have, any extra money in your budget to handle it. And so this is what happens. They estimated I got an example, they estimated your homeowner's insurance at $1,200 a month. The new insurance was $1,500 a month. So it's so important to contact your insurance company and find out what that insurance company is going to charge you for the next year. Now, I can't prove this, but I know that sometimes you might have a little teaser rate in there. I can't prove that. You go out and talk to the insurance company, they say, no, we don't do that, but they know that most people don't change insurance companies. So what happens? They estimated at $1,200. When they get the bill, it's $1,500. So there's $300 difference. $300 difference. So my first thought is go back to the insurance company that issued your policy and say, hey, what happened? Why did my payment increase? Maybe it was something you did. Maybe you filed too many claims. Maybe they had first approved you with a high credit score. Now your credit score has dropped. But you've got that $300 difference. So if you don't find an insurance company that can give you the same rate that you had of $1,200 a month, that $300 is an increase in your payment. Let's look at the property taxes, which we don't have too much control over that, but you estimated your property taxes were $2,000 a month. The actual bill that came in paid, I'm on the bottom of page 13. The actual bill that came in was $2,600. There was a deficit of $600. So you add that $300 plus $600, that's $900 deficit. You divide that by 12, that's $75 a month increase in your payment. So what happens? Let's go over to the top on page 14. So your anniversary date is in May every year. You're going to get that a new payment estimate. So now you have to pay back that lender. So they're going to allow you to pay them back over the year, $75 a month. Then you've got to start paying what the new estimate from your property taxes and homeownership insurance. That's another $75 a month. So for 1 year, you're going to see an increase in your payment of $150 a month. Now, after you've paid for it for 1 year, then that $175 a month that you were paying the insurance company back, then that will drop off and you'll just have that $175 a month increase. So that's why it's so important to monitor property taxes and homeowners insurance. Because if you have a fixed rate note, the principal and interest is going to stay the same. That will never change. But you will see fluctuations in property taxes and homeowners insurance. So if you do not monitor, you're going to have what I call a double whammy. So the lender will also give you the option to pay them back. So you won't see the payment increase by that additional $75. So if you had $900 maybe in that emergency fund or money set aside, then you could go ahead and pay that lender the $900 and you won't be charged, that for the following year. So what can you do? Review the taxes, make sure you dispute the value, remove your homeowner's insurance, and, start saving some extra money. Have that little extra money so you can make sure you can provide that, to your lender. Any?
How accessible is this information for homeowners, property taxes? Is something you gotta keep calling, or it's online?
Yeah. Yeah, he asked a question, how accessible is this information? You can go to the Dallas Central Appraisal District, their website, or Tarrant County Appraisal District, and they can give you estimates, on the value of the property. I really like Dallas County. It gives you a wealth of information. It'll tell you exactly what your taxes are going to be for the next year if you go online there. Huh?
So it's reviewed every year. I mean, it may change every year, property taxes.
Oh, your property taxes may change every year. Now, sometimes, they have up to 3 years, so sometimes they may not actually go out and make a change. Every 3 years, they're definitely going to be out to make the change.
I was thinking back on this question on how accessible is it? Because when you say make sure you're familiar with it, you're checking on it, it kind of sets a tone that it could change more frequently throughout the year.
Okay, no, it's going to be once a year. Because remember I said every year they're going to send you a statement in the mail telling you what your estimated value is and what the taxes are. So every year you're going to get that statement, in the mail. So you can always check that. But like I said, usually the Dallas County Appraisal District, usually, when that letter goes out, and I think that letter usually goes out in April. They usually have that information on the website real good. Private mortgage insurance usually doesn't change. That's usually going to stay about the same. If you have an FHA loan, that private mortgage insurance actually is going to be decreasing. So that you don't have to too much. The principal and interest on the note is going to stay stay fixed. That will never change, along with that private mortgage insurance. That's not going to change.
But once you get like a certain amount of equity in your property, doesn't the PMI go away?
Okay, her question is if you have a certain amount of equity in the property, then that will go away. It just depends on the type of financing that you have. If you have FHA financing, it's not going to go away. It will decrease, every year, but it's not going to go away. If you have conventional financing, and it is dependent on the lender's decision. If we're in a down economy and the lender does not see property values increasing, you could have 80% or less of the value, and they're still not going to take the MIP, the mortgage insurance off. So, but on a conventional financing, if that loan to value is less than 80%, then that mortgage insurance can come off. What's the time? Somebody need the time? How much? Almost one? Okay, let me hurry up and get through, and then if any other questions, you can ask me afterwards. So protecting your investment, You know, it's really important that you get involved in your community. I just think that is probably the most important thing anyone can do. Know who your neighbors are. You don't have to be buddy-buddy with them, but you at least want to speak to them and know who they are, you know, because they can watch your property for you. You know, I like nosy neighbors. You know, I didn't realize how many people knew what was going on in my house till something happened. And what was nice about it was one guy told me, he said, Miss Brown, if you just turn on more lights, we can watch your property better. I was like, oh, okay. Well, I've got those lights that don't come on with the action. But just make sure that you are involved. Usually neighborhood associations have really good neighborhood meetings that they have each month. Check the social media.